we are not going back to that low inflation, low nominal growth period that we had just after the financial crisis,
right,
up until the pandemic. The pandemic changed everything. We're in a world of deglobalization, frequent supply shocks, and much higher nominal growth rates, higher underlying inflationary forces, and higher interest rates.
Hi, it's a couple of topics I want to discuss today. Firstly, US inflation is much softer than expected in June, leading to a ruling out of a rate cut this month. Yet, equity markets are struggling. Hi, welcome to another Super Macro podcast. My name is Elvis, sitting opposite me, veteran hedge fund manager and the heart of Super Macro, Jonny Matthews.
Hi,
Johnny.
Elvis. How are you?
Oh, yeah, I'm good. How are you doing?
Yeah, pretty good, thank you.
Okay, I'm going to get straight into it. Let's start with the CPI prints.
Yeah.
Headline dropped from 4.2 to 3.5 on a year-on-year basis. The
US CPI.
US CPI, excuse
Okay.
me, correct. And the core dropped from 2.9 to 2.6. Wasn't quite what you were expecting. We discussed this last week. We discussed inflation most weeks. What are you thinking now?
First and foremost, I got it wrong. That's the first thought. But even so, if you look at the fixed income, if you look at Treasury yields, they actually ended the week almost unchanged, even after those much softer than expected CPI prints. The 30-year closed the week a basis point higher. So quite a surprising reaction.
So why?
Well, I think for a number of reasons. First of all, you're never going to get headline inflation back down to target until core inflation is at target. Never, or at least not on a sustainable basis. Let's put it that way.
Okay.
Because the swing factor is energy, not so much food. It's energy. That is going to push headline inflation all over the place. But ultimately, it trends towards core. And core has been elevated. I mean, it dropped to 2.6%. I think there are a lot of one-off factors that helped it get down to 2.6%. But I don't want to just say, I wasn't really wrong. It was just some special factors.
Is there a wash factor in there somewhere?
Well, it's nothing to do with what.
Not what the prints were, but I mean how the market's treating duration.
Well, I think the thing is, it's it obviously core and headline inflation both made a steep drop that was more than the market expected. However, wash does seem to be a dove, contrary to
the first meeting,
and to my expectations. He has turned particularly dovish, and he's going to look for any kind of reasons to try to persuade the rest of the committee that it's not necessary to tighten policy. I actually don't think he's going to be successful. I mean, we had, we had a few speeches from Fed officials. I mean, regardless of the fact that he wants to pull back on forward guidance, they're already opening
Waller,
their mouths.
And there was another, was it?
So Christopher Waller, he said, and he's the Fed governor, he said, just I'm paraphrasing this, the FOMC has to be ready to tighten policy. So, and Dallas Fed President Lori Logan, she's
more
a hawk.
hawkish.
She's more hawkish. She said, if inflation is not heading all the way to 2% on its own, then at least some policy restriction is needed to help it get there.
But that's just two of the Fed.
Beth Hammock, massive hawk anyway, she also said something similar.
Right, okay. So he's got his job cut out to change the direction of what they're thinking.
I think so. But, he's got his task forces and he's got his ideas for looking at trimmed mean inflation and so on. I don't think he's going to be able to persuade the rest of the committee. But, we'll have to see. And, importantly about inflation, it is very corrosive to investments. To fixed income investments.
As your first chart's going to show us.
If we bring up chart one, and here, what I'm showing is the consumer price index, the dotted line.
That's the dotted red line, yeah?
The actual CPI. So the consumer price index is now something like 28% higher than it was at the start of 2021. And you can see on the chart, it's something like 40, maybe 45% higher than it was 10 years ago.
2016.
2016.
New chart.
Now that is that means, okay, let's say it's gone up about 140%, rather about 40% in the last 10 years. Your $100 bill that you have in your pocket is going to purchase something like a third less as much stuff. And you're not going to get it back. You're not going to get that purchasing power back.
So bonds are not really a hedge for...
Well, the blue line really is how, long-term Treasury investors have performed. This is a Bloomberg index of Treasury bonds of maturity of 10 years and up. And, if you put your money in 2016, I think the 10-year yield at the time was about 2%. But basically, when the yields dropped, you were doing very well in 2020, but they've gone back up, and the coupon payments this assumes the coupon payments are being reinvested as you go along. And now, after a decade, in nominal terms, you haven't made any money.
In real terms, you're losing money.
In real terms, the CPI is 40% higher.
So when you get your money back...
It's gone. The money's gone. You're not getting it back.
You get your money back 10 years later and it's worth a lot less, but you haven't earned much out of it in lending the money in the first place.
And the point is the CPI isn't going to go back down. And if anything, I think we're in an environment, I've said this several times before, we are not going back to that low inflation, low nominal growth period that we had just after the financial crisis,
right
up until the pandemic. The pandemic changed everything. We're in a world of deglobalization, frequent supply shocks, and much higher nominal growth rates, higher underlying inflationary forces, and higher interest rates.
So you've got a negative You've still got a negative outlook for bonds.
Yeah.
Duration rather than just a bond.
Yeah, rather than short-term.
Bonds, duration. Let's talk about equities. That's the second part I want to talk about.
Of course.
We had a couple of big events last week that seemed to be, I don't know whether the spark I'd call it the spark. First of all, IBM's numbers, which looked a bit crap, and 25% down as well.
Yes, the market dropped 25% in a day. Yeah.
And then we had the Chinese startup, Moonshot, which unveiled its OpenAI model. What do they call that? Kimi K3, which is apparently matches the offerings from OpenAI and
in terms of performance,
and
at a much cheaper cost.
At a much cheaper cost. So it brings into question these hundreds of billions of pounds that are being invested this year in the large language models, also next year. And what is going to be a return on investment if there's much cheaper models available in the market, or will be available?
Yeah, there's two things here. First of all, let's I don't want to focus too much on single stocks, but the IBM, because I love what the CEO said. This is CEO Arvind Krishna, and he's got this brilliant bit of corporate jargon.
What was he saying?
He said he warned of a capex reprioritization, and what that means is
they didn't buy our goods.
People aren't buying our stuff anymore.
Yeah.
It's just it's a wonderful bit of a euphemism.
The market didn't buy what he said there as well either, on the basis of the fact that the stock was down 25%.
Yeah. So, but it wasn't just IBM's stock that suffered on the day. The read across was really to other providers of software and IT consultancy services and so on.
So this was it was a spark, wasn't it, to remind everybody there's
it's not all plain sailing in the tech sector. And then, as you say, we've got this new kid on the block, Moonshot's Kimi K3.
Yeah.
And it really kind of threatens to upend the whole story about how there will be...
But this is a rerun of last January, is it, to a certain extent, isn't it? When we had, what was the other one? DeepSeek. And that
but the market recovered from that
very quickly. But this time...
But here, it's a second thing. And, the amount of spending on AI infrastructure and on AI development has really soared over the last year. In fact, in the last year.
And equity prices have gone dramatically.
And now you're calling into question the potential returns from all this investment, or certainly investors are.
So is it really a question of, these big hyperscalers, I've started, so I'll finish. They've spent this much money so far, they're going to just keep piling into it till they get to one of them effectively wins.
Well, I think, the market may start to increase the discount rate that is applied to those future earnings, may increase the cost of capital to the hyperscalers. It may not be quite
slow them down to a certain
It may
extent.
not be quite so easy to raise the capital that they need to make these investments. But at the moment, there is still this enormous momentum behind the investing. The sector that really got it in the neck last week was the chip sector, and let's just show you chart 2. This what has been going on within the tech sector, and I've spoken about this previously about how the hyperscalers and the chip stocks they were quite closely correlated up until about
prices started going through the roof.
Well, what happened was the hyperscalers, if you can see the red line there, the hyperscaler share prices peaked round about September or October of last year. And then it was the chip stocks that took up the running. And then they really went crazy at the start of this year.
But you made a point a couple of weeks ago, which I thought was very poignant. You said it's a zero-sum game. All right, okay, the manufacturers of these chips, memory chips, they're earning a lot more money, will earn a lot more money, and that's why we've seen the price of the equities gone through the roof. But someone's got to pay for it.
Yeah, it's not exactly a zero-sum game, but it's beginning to resemble certainly the hyperscalers, a bit of a zero-sum game. There may just be one or two winners out of it and a lot of losers. That's the thing.
Yeah.
The way things are at the moment is that the buyers of chips, the hyperscalers, are struggling now, and the makers of chips have had a great time. But in more recent, if you bring up that chart again, chart number 2, more recently, both of them have started struggling, particularly the chip sector. And what really concerns me about the chip sector is the leveraged exposures that there are within the sector from leveraged ETFs.
Oh, Christ, Korea.
Yeah, well, it's not just Korea, it's in the US market as well. Just to give you an example of this chart, here we are, chart 3. This is the red line. There is a 3 times leverage. Yeah,
look at the tiny little turn down.
It's a 3 times leveraged
semiconductor index, and this thing
ETF.
drops. I don't know, was it from 12?
Well, it's more than halved.
It's halved.
You've got to bear in mind with these leveraged ETFs, whether they're on an index or a single stock, at the end of each day, the manager of the ETF has to rebalance. So if the underlying stock or index has gone up during the day, the manager has to buy more to cover the next day. So
you're short a bucket load of end of day gamma.
You're basically short of gamma. In other words, if the underlying index or stock goes up, you have to buy more, and if it goes down, you have to sell. So you're constantly going against the direction. What you're being whipsawed if the market becomes volatile. It's fine on a smooth
going upwards. You keep buying.
Yeah, it's fine, but as soon as it reverses and becomes choppy,
then you get chopped
bleeding.
to pieces.
You get chopped to pieces, and you can see that. You can see that in chart 3. The volatility in the semiconductor complex has now become quite intense, to put it mildly. And don't forget, some of these companies, like, for example, Micron became a $1 trillion company, is no longer a $1 trillion company. But these companies are moving on implied volatilities of 100, which suggests the underlying stock is moving on average about 7.5% each day. Now, that is an enormous amount for a $1 trillion. Yeah. So,
this is not a tiddly little company.
It's
with
$75 million of market cap being created and destroyed on a daily basis. And there's a bunch of them doing it. So that sector has become extremely volatile and dangerous. And I think the ETFs themselves is a bit like the tail wagging the dog. Certainly in Korea, the Korean exchange is now scaling back, has put a temporary halt on new issuance.
The concentration of stocks in that index is like a couple of stocks control the index, and they're the tech stocks.
Yeah, there's 2 semiconductor stocks, Samsung and SK Hynix, which are extremely volatile, and they have a heavy weighting in the Kospi index. But those stocks themselves have double leveraged ETFs on them. And the ETFs themselves, I mean, SK Hynix, I believe the stock volume that the ETF, the double leveraged ETF has to trade each day, it's something like 2/3 of the daily volume.
Oh my!
Yeah.
So they are the price. They are the price discovery place.
In a way, they are the tail that's wagging the dog. The stock goes down, they have a ton of stock to sell, and if it bounces, they have a ton of stock to bounce, to buy. So there's a lot of volatility, and one of the things that's happening, if we look at charts 4, this is just from this is just from Bloomberg's snapshot of factors to watch. So these are the various factors that are performing well and not performing well, and for years, momentum has been the factor.
Absolutely solid, wasn't it?
Yeah, I mean, over 10 years, it's got a fantastic
328% over 10 years. That's enormous.
Yeah, so this is the stocks that exhibit strong momentum, either upwards or downwards. There are hedge funds, there are ETFs that will trade on that basis, long the stocks with strong momentum that are heading up and short the stocks that are heading down. But momentum had a really tough week last week, one of its worst weeks in I don't know how many years.
Does this continue, you think?
I do think so. The way the volatility has escalated in the single stock complex, and I've got 2 charts really. I've shown this before.
Yes, you have. The next chart. Yeah.
Chart 5.
It's even more extreme. Jeez, look at it.
Yeah, this is the red bars. The red line is the it's like the VIX for
the top 80 stocks.
Yeah, the top 80 stocks from the S&P 500 is the average vol for those top 80 stocks. And the blue line is the VIX, which
virtually 3 times what the VIX is in terms of implied vol.
Yeah, I mean, you can either look at it as a ratio or as a spread. For people trading the dispersion trade along a basket of single stock vol and short the index, they're having a great time. The stocks are flying around like crazy, and the index is really, it has not been that volatile, which is why the VIX is where it is.
Is that has with a big capital H?
Well, that's the thing. I think considering how some of these some of these largest market cap stocks have become incredibly volatile, and they are the ones that are driving the index moves. But at the moment, they're not correlated with the rest of the market. So the stocks are flying about in either direction.
But then the index itself is looks calm.
Relatively calm.
Is the multiple the index trades on per se expensive?
Well, if anything,
was it trading on about forward 21, something like that?
It's come down slightly. The earnings growth has been so strong.
Oh, so
Q1
it makes it more attractive. Yeah.
And Q2. Yeah, Q2 is probably going to carry on at something like 25% year-over-year earnings growth, earnings per share for the S&P. And if you look at the forward multiple, it's down at something like 20 now. It's come down from about 21 because analysts are still projecting very strong earnings growth. But what typically happens is those projections lag the market. If the market sells off,
then the projections start getting marked down. Yeah. So, okay.
So you've got to be a bit careful there. And another way of looking at this, chart 6.
Oh, yes. Yeah.
And I'm whipping through this quite quickly. This is just a measure of correlation between the single stocks. I don't want to get into too much detail over how this is calculated.
But this is a measure. All-time low near as damn it.
It's just off its all-time low. This is basically telling you that the correlation between any pair of stocks within the S&P 500 is extremely low. And it's just telling you that on average, the stocks are just not moving in a correlated fashion. Now, that can change. I don't know what will make it change.
Yeah, but that's the question that I suppose most investors will be asking themselves. Is the movement or the volatility, the extreme volatility in one or two sectors going to infect the rest of the market, or will it stay within an area that's controllable?
That's the key thing. I think the risks are building. And I think at some point the correlation may start to pick up. In other words, further declines in these tech stocks may start to infect the rest of the market. Because don't forget, it's not just purely the tech sector that has driven the market higher. The industrials have also done well. The makers of engines, the makers of air conditioning units for the AI build out, and so on. There are other sectors of the market that have done very, very well.
So maybe it triggers the level of the VIX, maybe. I know it's not something we normally discuss here, but is it something like that, whether if the VIX started to... Where's the VIX at the moment?
Well, you can see it on that previous chart. It's something like 16 or 17. From memory, I don't know.
If that gets to 25, somewhere plus over that, maybe that's an indication that things are starting to unravel.
Oh, by then it would already have happened, I think. Obviously, we've got the earnings just getting into gear now. We've got more corporate earnings coming up.
It's not really about the earnings, is it? It's really about what the
face
forward
it,
guidance comes from the CEOs.
Yeah. I mean, if you miss, I think what tends to happen at the moment is any company that misses, like IBM, gets severely punished.
How can they guide? Surely they're guiding lower if they're not doing so well. This is what they do. They get the bar low enough and they beat it normally. That's what
typically. But I think there's been so much enthusiasm behind this AI trade.
Oh, I see. So anything AI's got to be really good.
It has to be really, really good. I mean, we've had some disappointments recently, despite incredible earnings increases. I think. What was that chip stock recently? 19-fold increase in profits.
You wrote about it, I know.
6% above expectations, and yet the stock dropped on the day of the release. I
can't remember what it was now.
Well,
you've definitely wrote about
that. That shows you the kind of risks that there are. Plus, we'll come back to the I've spoken about this previously. Chart 7, the supply that's coming down the pipeline. And here, what I'm showing is the net equity issuance retirement. And we've had...
This is per quarter you're showing it,
isn't it? This is quarterly net issuance and retirement. And
so the last red line is just the first quarter of 2026.
2026. And what this is showing you is that quarter by quarter... For the last two and a half decades, since the start of this century, on balance, companies have been executing stock repurchases,
stock buybacks,
and there's been enough cash-financed M&A activity that, on balance, net equity issuance has been negative. Now, that has been a tailwind to the market. That means that...
Of course.
Yeah, but companies buy back their shares.
There's less equity around.
It's not only that. When companies buy back their shares, it boosts the earnings per share.
Oh, yes, yeah.
So you've got, but as you rightly say, there's less equity around and there's less supply. So 2.5 decades of very benign equity net issuance, which was actually, for the most part, negative, has now turned positive. And it's going to become increasingly positive.
Yeah, you've talked about this, and no, I think we've got some more IPOs. We've got the Anthropic, and this year, and there's going to be obviously more debt being sold by a lot of the hyperscalers, I assume.
Yeah, but if we just focus on the equity, as you say, Anthropic's IPO I think is slated for this October. After that is OpenAI, possibly towards the end of this year, and these are big lumps of capital being raised. Potentially 100 billion, each of them. SpaceX IPO'd, but...
Oh, yeah. The insiders now got a chance to dump some of their stock.
Early in August, the insiders can start selling their shares, and it's a significant amount of equity. I think there are, I believe, over 900 million shares will be released, will be unlocked at the start of August.
But the overall market's taken.
Well, bear in mind,
we all know this is coming.
Yeah, but bear in mind,
we're close to the highs of the market.
Just to give you the scale of this, 900 million shares. I mean, you're talking of over $100 billion worth of potential stock supply from SpaceX. Okay. And don't forget, it's already down below its IPO price.
Yes, I saw that. Yeah.
And if you're an insider, if you're, let's just say you've worked there for many, many years. And now you've got some stock to sell.
You've got a couple of £1 million worth of
and
stock.
it could be a life-changing amount of stock.
I'm dumping. It doesn't matter what the price is.
Absolutely. It's time to get out.
Okay.
So that supply is coming. So if we go back to chart 7 and you look at this most recent quarter, first quarter of 2026, that red bar is $25 billion worth of supply. Now,
wow,
net supply.
That's going to go up dramatically.
That is going to go up dramatically in Q3 and in Q4.
But the market, it's not as I was telling people or talking about something that other people haven't discussed, but the S&P doesn't seem to care.
No, look.
What are we off? 1.5% off the highs, something like that?
Yeah, a couple of percent off the highs. Look, I'm not suggesting that we're about to go into some kind of meltdown.
What are you suggesting?
What I am suggesting is that I think it's going to be tougher going over the next few months. And I think there is a meaningful risk of a pullback somewhere between 5 and 10% over the next month or two. That's what I think is a strong possibility.
Your thought on and just very, very quickly, your thoughts on bonds, couple of sentences.
Well, I'm still
wrapping up.
Yeah, I am still bearish of treasuries. I just think the central banks. I mean, look, we've got the ECB meeting this week. They're not going to raise rates. They also had a downside surprise in inflation.
Inflation, yeah.
I think September is still on the cards, and I think the meeting will sound hawkish. I think they will guide towards a September hike.
And we've got hostilities that seem to have ignited again, which is pushed our crude and energy
Nobody
prices
knows
higher.
how that is going to turn out.
No.
But, if we put that to one side and assume that maybe, a new peace agreement gets signed somehow and things calm down, even then, I think, it's like a pig in a python. The inflationary impulse is already there. It's traveling through the system. We're going to see second round effects. And we're going to see that's on top of what I think were persistent underlying inflationary pressures anyway. We never got core inflation back down to 2%. So, I think we'll see inflation picking up again in the third and fourth quarter.
For people listening, just can you summarise what you're thinking about equities and bonds and what we've discussed today?
Well, I've spoken about bonds. I'm still quite negative on bonds. I think 4.5% is a floor now for the 10-year Treasury. 5% will act as a floor for the 30-year. It was a ceiling.
Right.
I've said this many times before. So you've got the higher long-term rates, which means that any future cash flows from equities or any other investment
discounted more.
Have to be discounted at a higher rate. I think for the equity market, there are headwinds. There's a surge in supply coming down the pipeline that we know about. The increased single stock volatility means that many funds will have to scale back exposures simply because their value at risk will go up. And the third factor is the intensifying competition in the sector that has driven most of this year's rally, the AI-dependent sector. Intensifying competition from China and new entrants.
Which we discussed earlier.
So I am kind of concerned about these headwinds and both to bonds and to equities. So it's not the time for pushing the boat out in terms of risk. It's time for scaling back risk.
Okay. So if anybody wants to read in more detail what you're thinking and get a chance to look at the portfolio you're running, how can they do that?
Sign up for a free trial subscription, super-macro.com. Each day you get a daily note, summary of the day's macroeconomic data and what it means. And then the weekend is a more detailed run through from the major economic regions and the markets and what's going on in the markets and what I think is going to happen.
As you've said previously on numerous occasions that you write down what your thoughts are, it crystallizes those thoughts into making your trading a lot better.
I'd often read from other trading coaches that by writing a journal it would help improve your trading, and I've found that it really has helped improve my trading by writing this daily note. The discipline that's involved in doing the analysis and then putting your thoughts into writing and explaining what's going on, the amount of research and the depth of understanding that you need to be able to do that really clarifies your thinking. It's been a great benefit to me.
Thank you, Jonny.
Thank you, Elvis.